But I'm now joined by Liam Halligan, the great expert on these matters and GB News' business and economics editor. Liam, this is good news, and it's better than people were expecting. The one thing that worries me is inflation is a lagging indicator, and it responds at an imprecise way to changes in interest rates. And interest rates have gone up from 0.1% to 5%. This has really whacked families' incomes as mortgage rates have gradually fed through. Could the Bank of England have gone too far?
I think they have gone too far, Jacob. We've had 13 interest rate rises in a row. I've been calling for 2-3 months now for the Bank of England to stop and let those interest rate rises take effect, because, as economists have proved over generations, monetary policy changes in interest rates work with long and variable lags. They take time to feed into the system, particularly when mortgage rates are fixed for lots of people. But look, this is good news. We've come down from 8.7% inflation in May to 7.9% in June. It's still high by international standards. It is 3% in the US, 5.5% on average in the Eurozone. The next time the Monetary Policy Committee of the Bank of England meets to implement an interest rate change or to decide is the 3rd of August. Until this inflation number came out today, the financial markets were betting the Bank of England would go for another hefty 50 basis point, as we say, half percentage point interest rate rise from 5 to 5.5%. If you look at financial markets today, it may be financial markets say they're only going to go for a quarter point, so 5% to 5.25%. I would say keep it at 5% and see what happens. The Bank of England isn't going to do that because the Monetary Policy Committee is riddled with groupthink, and I don't think they've got the courage and the imagination to do something that the markets aren't already expecting.
And that is the problem, isn't it? That when people make a mistake in managing money, they tend to overreact. They go too far in the opposite direction, take the opposite risk from the one that's failed the first time round. And this is quite worrying because the increase in mortgage payments for people, if you assume a sort of 1% margin for the banks, has gone from 1.1% to 6.1%. I know everybody isn't on a floating rate, but week in, week out, more people's loans expire, and they're being whacked by this. It's pretty severe, isn't it?
Look, if you start at the beginning of this year up until, say, next autumn, when there could be a general election, you're talking about 2.5 million households who are going to come off those 5, 3 and 2 year fixed rates that were fixed at a time when interest rates were ultra low, less than 1%, sometimes down at 0.1%. Those deals expire, and so they face a cliff face. They go from mortgage rates of 1 or 2% to 6, 7, even 8% in some cases. And what the Bank of England has done, they'll say, we can only say this with hindsight, some of us were warning at the time that this would happen, is they were too slow to raise interest rates to tackle inflation because they kept saying it was transitory. When they did get going, they were too cautious, not going for big rate rises, but little itty-bitty rate rises. And now, because they're under such political pressure, because inflation, even after today's good news, is still 4 times the target, they're overcompensating, they're compounding their original error by going for rate rises that go further and are bigger than now we currently need. The economy has stalled officially. GDP growth is at 0. And the Bank of England is in danger of making interest rate rises now, which push mortgage rates up further, impose more pain, but will only have effect in 12 or 18 months' time when the economy will be in a completely different place.
And it's affecting businesses as well, who also have to roll loans over. How would you improve this? Is it about changing the people on the MPC, or is it about changing the structure? Is it about questioning Bank of England independence and looking at making it more political once again?
A couple of things. No national newspaper columnist or commentator has been more critical of Andrew Bailey than me. I don't say that with any kind of satisfaction. I don't set out to personally attack people in any way. It's a very difficult job. I wouldn't look to change the Bank of England governor in the middle of a situation where we are under international scrutiny for how we run our economy. It would make us look like a banana republic, frankly. So we should stick with Bailey for now, but learn the lessons. And I don't think we should particularly change the Bank of England's model. The problem isn't that the Bank of England is independent, Jacob. The problem is that it isn't independent enough. And what do I mean by that? I mean that the 9-strong Monetary Policy Committee of economists, including the governor and senior bank officials, but also some independents, the independent members aren't really independent anymore in the sense that they're all handpicked by the Treasury. When Monetary Policy Committee was first formed in 1997, you and I have disagreed with Gordon Brown quite a lot over the years, but at least the Monetary Policy Committee had genuine, high-calibre, highly intellectual, streetwise outsiders who thought outside the box. These people aren't household names, but they're well known within economics, and they had the licence to do and say things that weren't kind of sanctioned. They weren't the normal suspects. Now we've got sort of plain vanilla economists on the Bank of England's Monetary Policy Committee, and there's a lack of proper diversity of cognitive opinion, which is why I think the Bank of England was behind the curve.
And there's the other part as well, isn't there? There's the issue Rachel Reeves raised, which I think is so important, of high energy prices. But actually, Labour would make even higher energy prices because we've gone for the net zero agenda, which forces us to have high-cost energy. And that surely is a mistake. You look at the US and how much faster inflation's come down. It's because they've embraced low energy prices.
I think a major part of the explanation for why US inflation is so much lower is because when the Federal Reserve got going, it was really bold in its interest rate rises. It did successive 50 basis point, half percentage point rate rises. It didn't muck about and try and apologise for what it was doing like the Bank of England did. That's one reason. The second reason, as you rightly say, is that energy costs in the US have been so much lower. Throughout 2022, on average, get this, because it's such a horrible statistic to get your mind around. Throughout 2022, on average, I've done these calculations, the average price of wholesale gas in the US throughout that year, and of course there were massive spikes and troughs because of the geopolitical fallout from the war in Ukraine, the average price of the wholesale gas in the US was 1/5 of the average price of wholesale gas in the UK. And that's why there was such massive, what we call arbitrage, huge gas exports from the US to the UK and then on to Europe through LNG. The US became the world's biggest gas exporter during the last year.
Its energy was 1/5 of the price. Thank you, Liam.